Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, The Future Economy, Opportunities for Growth. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, this is the third session of our virtual 2022 Building Opportunity Conference. Over the span of this conference, we will cover trends and opportunities shaping the built world. For more information about our conference and the sessions, they are available in the links provided in your console as well as on mossadams.com. And now I would like to hand it off to today's moderator, Elaine Irvin, partner and construction, real estate, professional service, restaurant, and hospitality national practice leader at Moss Adams. Elaine, the floor is yours.
Thank you, Amy, and welcome to today's session. It's a great pleasure of mine to be able to introduce today's speaker. Today we have Andrew Busch. He is the former first Chief Marketing Intelligence Officer for the U.S. government and an economic futurist at andrewbusch.com. For the CFTC, he was charged with improving and enhancing the government's understanding of the markets and the economy. His job was to take all of the news, information, and data on the economy and markets and filter it into condensed, easily understood research. Andy provided economic market briefings to the White House, U.S. Senate, U.S. House, the SEC, the Federal Reserve Board, and the U.S. Treasury staff on a wide range of issues, including extreme market volatility, China's influence on trade, and the impact of technology on the economy. Today, he's a consultant and keynote speaker with a wide range of clients, including agriculture, chemicals, financial services, energy, manufacturing, construction, and board of directors meetings. Andy moves people from the chaos of today to the confidence in the future. Thank you for joining us, Andrew, and we look forward to your presentation.
Great, thank you. Ukraine war, inflation rising, interest rates rising, stock market crashing. It seems like the world is just speeding up and it's coming at us so fast that sometimes it's hard to stop and think, how did we get here? And it's even harder still to think, where are we going? Well, the good news is today, humbly stated, I'm going to help you with that. I found in my experience that what's missing from so many presentations is context for understanding the world. So today, what we're going to do is a little bit of where we've been so we can understand where we are, so we can see where we're going. And to that end, here's the structure for today. And what I've found often is that if you do want to see the future, a lot of times you got to look over your shoulder to the past. And we're going to do that today. So we're going to go through the economy. I'm going to tell you about inflation. I'm going to tell you about interest rates, stock market, all sorts of stuff, labor supply, supply chain disruption, all of those things that are driving everybody crazy. And then we're going to morph that into government policies and a little bit on the elections, since they're right around the corner. All of these things wrapped together into those two sections to really give us the background that we need to understand the trends that are going right now, and of course, future growth opportunities. And at the end in that section, I'm going to do something a little bit unusual. I'm going to hand you my crystal ball. I kid you not, I've got a crystal ball. And it works, actually. I think too often we're just looking at like 18 months to 3 years in the future. My crystal ball looks at 5 and 10 years down the road. So we'll have a lot of fun with that. Now, I know a lot of you want to do a deeper dive into getting the research that we produce, and you want to really learn more about these topics. Well, this QR code will take you right to my website, to the research page, and you can get all that research for free at andrewbusch.com. So if you want that, deeper dive's right there available for you. And speaking of a deeper dive, why don't we start this by doing a little bit of polling? And I think this is really just going to set the stage for your view of what's happening like right now. So go ahead, let's do the polling right now.
All right, so the first polling question is pulled up, and I do want to give the audience a heads up that we're going to move through the polling questions pretty quickly since we have a lot of content to cover today. The polls are located right on the slides, and to respond, you're going to click the button next to the answer you choose and make sure you hit that submit button. The first question is, what is your top 12-month challenge? And A, labor force, B, supply chain, C, energy costs, D, recession, or E, election impact on regulations. So again, we're going to move through.
Yeah, I was just going to say, you got about 10, 15 seconds to go through these, so please respond. And then we'll pop up the results, right?
Yeah. All right, it looks like people are responding quickly. So here are the results.
All right. Yeah, a lot of worries about the possible recession, and we'll definitely talk about that. And obviously, labor force is one of the biggest problems that are out there right now for so many companies across so many different sectors of the economy. Almost everywhere I speak, it's almost the number one question that I get asked, what is going on with labor supply? So we'll talk about that. All right, let's jump into this. Let's talk about the past. I'm going to do something pretty crazy here that I bet you're not ready for, and that's this. I'm going to actually explain why the stock market went up from 2020 to the beginning of 2022. Now, this next slide should really, I guess, let me take a step back. So at my company and my consulting company, we spend a lot of time with data analysis. And when you do a lot of data analysis, whether it's machine learning and so on, you really look to visualization to try to best capture how the data is really telling its story. And to that end, I think this really helps with the data visualization for understanding why stocks went up. Yeah, that's right. Who's seen this movie? Just raise your hand. Yeah, not many people admit that. I've seen a few of them, but it's kind of funny. Obviously, one section of this is when they shoot somebody out of a cannon. And I love the tagline on this that it says, some people never learn. Well, we certainly did not learn at either the fiscal side of the things with the federal government spending a ton of money or from the Federal Reserve. So here's what I'm going to show you that should just completely blow you away as far as the total amount of stimulus spending and stimulus that was provided to the U.S. economy. Take a look at that number. That's 14 with a T trillion dollars that we made available for the U.S. economy. And I'm not even talking about the bipartisan infrastructure plan, nor the latest IRA or Inflation Reduction Act. No, those are separate. This is just the 4% programs that we put together, the last one being the American Recovery Plan, plus all of the stimulus that the Federal Reserve provided. That is a crazy amount of money. Now, this wasn't like the global financial crisis back in 2008 when we said, oh, maybe we'll, do TARP, or maybe we won't, create a lot of volatility there. And then it took Ben Bernanke until his appearance in 2009 on 60 Minutes to really let everybody know that he was going to save the U.S. economy by flooding it with cash. That's not what happened this time. What happened this time was Congress said, look, we want to spend a bunch of money. We want to send it out as fast as possible. They go to the Treasury, and the Treasury goes, bam, no problem. We've got lists of people. We can direct deposit it into their checking accounts, and they can get the money in literally a matter of a couple of days. That way they can pay for their groceries, they can pay for their rent, they can pay for their car, they can pay for their mortgage, all of those things. That's why the U.S. economy went from down 30% to plus 30% and rock and rolled in 2021 after that. So keep that in mind. That was a lot of money that was flowing through the economy all at the same time to get it going again. And if you think about it, the U.S. economy basically is 70%, of consumer spending, and 70% of the consumer spending is on services, and 30% is on goods. Well, if you can't spend during the shutdown on services, so you couldn't go to a bar, you couldn't go to a restaurant, you couldn't go out to eat, all of those things, you take that away, and all of a sudden people start to look to other places if they have money to spend. Plus, they were working from home, so everybody needed an iPad or a computer or a new desk or a new chair. So the amount of money spent on goods started to bump up. And that only went up by about 5%. And guess what? That was going on globally. And no, we could not handle that from the standpoint of a supply chain. And this is what happened. Yeah, we were already stressed when it came to a supply chain because we already had a tariff war going on between the United States and China. And then we had China shut down in February of 2020. And then we had the U.S. and Europe shut down just after that. Then we had, the Suez Canal. I mean, who had a ship stuck in the Suez Canal on their economic bingo card? I did not. And that also caused a lot of problems. That was crazy. One of my favorite pictures of all time, that little steam shovel at the bottom, like trying to dig out a big ship, that was hilarious. But then, of course, what's not funny is the Ukraine war. And that changed so much of what's going on, so much with supply chains, but also with energy, clearly. And then China continues to, shut down and reopen their economy based on their zero tolerance program. So all of that led to a lot of supply chain stress and a lot of supply chain problems across the entire spectrum of the economy. And so that's really challenging. And with all that going on, then it's not surprising that we had this, which is inflation jumped significantly. This is last month's numbers, 8.2%. And if you break this down, it's mainly energy, but energy goes across the entire economy, right? It's not just predicated in the energy sector. It's not just the cost of energy. It's across all platforms. Specifically, it goes into transportation, but food, of course, last mile, when you transport goods, especially food. There's all sorts of other things, rail, go down the list. They're all impacted. So I think it's just really important to understand how energy impacts so much of the inflation that's gone on. Cars as well. And we'll talk a little bit about chips in a little while. But chips is probably the poster child for an enormously elongated and stretched and thin supply chain. I mean, there's so many parts to going into a chip. Some of them, some of them get produced in Taiwan, but they come from very special, to produce that chip in Taiwan, you've got to get the design out of California, you've got to get some specialized gas out of Japan, and then you've got to get another component out of Norway. I mean, it's crazy once you dive into how chips are made. And so if that gets disrupted at all of a sudden you don't have chips for autos, and then you don't have chips for PCs and things like that. So you can understand the stress that was going on with CPI. Now with that, there's a lot more to this. Obviously, with the war in the Ukraine, that changed a lot of things. And if you think about energy overall, what we've discovered is two things. Number one, oil is a global market. It doesn't matter that people sanction Russia and that they try to stop buying Russian oil. Because why? Because China and India just bought as much as they could at very discounted prices. So it's not surprising that oil went up to 120 and they came right back up. What has created a lot of volatility, of course, is in natural gas. That's a regional issue, and that's really based on a pipeline and LNG terminal. And what we know is that Russia was sending a lot of natural gas to Europe, specifically to China, specifically to Germany. And that's really where we got this tremendous volatility when they declared war or decided to have a special military option going into the Ukraine. And you can see the volatility that went into natural gas. Now, natural gas and hydrocarbons go into a wide range of products. And I just want to point out if you think about 4 products overall that are just super energy dependent: plastics, steel, cement. Those are, and fertilizer. Those are 4 products that just demand hydrocarbons and specifically natural gas to get them to be created. So as you have volatility in the natural gas market, you have volatility in the building materials markets as well. And you can see. Now, I will tell you the good news is that natural gas has come down significantly in the United States, and it's come down significantly in Europe. It's about 25%, maybe 20% of what it was at its peak in Europe. So that's come down significantly. Keep that in mind. I should say not 25%. No, that's right. 25% of where it was. It was crazy for a while. Here we've dropped by about 44%. But keep that in mind when we're looking at things and trying to understand the way that the world works right now. Labor costs, obviously these are significant. This comes from the Atlanta Federal Reserve Wage Tracker Index. And you can see that the overall rating was at 6.3%. And basically this has been on fire for some time. There's a lot of reasons for this. We lost 2 million workers during the shutdown to Social Security to some extent because they didn't want to go back to jobs if they were at risk. So we had 2 million more people retire than we thought were going to. Then on top of that, we shut down the southern border, so we weren't getting any workers in. Then we have a much smaller demographic of the 20 to 28-year-olds after the big batch for millennials. So now you begin to understand why there's such a problem with labor costs. And if you think about it, right, as we transition eventually from goods producing, where we had that bump, and take a look at services, if you try to ratchet that services back up, and the demand did come back up for it, I'll talk about it in a second, but as you go back up to that, the services side of things, you can't attract enough workers. So that's a problem. That's a reason why we're seeing such elevated levels when it comes to labor costs. So let's get into the present right now. Now I get to explain the bad stuff, right? Sorry about this, but yeah, this is kind of a downer. It's not a surprise. Why? Because our central bank has finally reacted to the inflation that's out there. This is what the Fed has done. They've raised interest rates extraordinarily aggressive. We went from basically 0 to 3.25, and the markets are expecting them to go a lot higher than that. The Federal Reserve is telling us in their predictive end of their communiques that they expect interest rates to be at 4.5% by the end of this year. That means they got to do 75 basis points probably in November and another 50 in December to reach there. So raising rates this aggressively, that changes the landscape when it comes to risk. And I want you to keep that 4.5% in your mind because we're going to talk about it in just a second. But more of this is coming. Now, sadly, it's not the only thing the Fed's doing. They're also reducing their balance sheet. Now, I'm going to get really technical here using my forearm. Okay, ready? This is the yield curve, believe it or not, right here, right? Short end, long end. So when it's up high, right, and the Fed wants to stimulate, they cut short-term rates, so they drop my elbow down. But they got a problem here, right? They got to reduce long-term rates, so they start buying securities, treasuries and mortgage backs, right, GSE debt. Now, if they want to do the opposite, they start to raise short-term rates, but then they got a problem at the long end, so then they start to put those back out, and that's exactly what's going on right now. They're releasing $95 billion a month of their balance sheet. And remember, they went from $4 trillion to $5 trillion. That is a lot of money sloshing around in the economy. All right, finally, that's not the only thing that's going on. Our federal government has reduced down the amount of spending this year by 20%. I know that's hard to believe, but it was so big last year that I don't even think God could have picked it up. Put it that way. There was a ton of money going out the door. Now, what I'll tell you is this. When it comes to investing in risky assets, it's so much easier to make money when the Fed is stimulating and the federal government is stimulating, right? That's good, thumbs up. But when the Fed is taking it away and the federal government's taking it away, that's not good. And that's what we're seeing right now. So this is problematic. And that's why we've seen stocks come off dramatically. If you think about tech stocks, just as an example, if we use the discounted cash flow of looking at earnings, right? Where you've got earnings in the numerator and a discount rate in the denominator, right? That's how you look out 10 years for earnings and whether or not you want to own that company. Well, if the denominator, if that interest rate that you're using to discount is 0, then anything you got in the numerator looks fantastic, right? It looks great. And that's what tech companies basically had, a lot of them. But now all of a sudden, that denominator is like 3.25, and it's going to go to 4.5. All of a sudden, if you've got meager earnings, you got a problem. And we've seen tech stocks really tank because of that. So that all wraps together there, but it doesn't tell, of course, the whole story. Here's the bigger story. We're not the only people doing it. 90 central banks from across the world are doing almost exactly the same thing. They're raising interest rates and they're reducing their fiscal spending because of the inflation that's going on around the world. This is a major problem, obviously. Now, this is the part where I have to tell you an economic secret, and it's a big one. All right, here it is. Ready? Most economists stink at predicting the future. I know, who would have thought that, right? The reason why I say that is go back to December of last year. What were most economists putting out there? And I'm talking like everybody, not just one person. Their models were predicting 3% growth on average for 2022. What did we get? This, minus growth, minus GDP for the first 2 quarters of the year. Now, a lot of people will say that's a recession. Okay, perhaps it is, but this was really driven by inflation. Now, in fairness to all those people that are economists out there, I would say what their models miss is something that I call humility. In other words, the X factor, right? The X factor is an exogenous factor that you stick on the back end of your model that gives it the ability to be flexible in case something bad happens. And you try to plug in there like plus or minus something of something bad happening. And what happens with most economists is that they don't pick up COVID or they don't pick up the Ukraine war. Those are all things that are really challenging for a lot of economists overall and everybody else. I will tell you this. I want to let you in on just one more secret. Ready? Here it is. I wrote a book in 2007 called World Event Trading that no one read. I'm not kidding. Nobody read this. I gave 2 copies to my parents. I don't even think they read it. I think they used it as a doorstop someplace. But the reason why I bring this book up is because back then I was thinking forward, and I wrote a book, World Event Trading, and the first 5 chapters were on infectious disease outbreak and their impact on the economy and markets. The other sectors of the book were short-term war and elections. All of these things are happening right now at the same time and are impacting the economy and the outlook and the markets. So if you're wondering why you're listening to me today, that's part of the reason why I've done my homework overall. And this is what I'm seeing, which is kind of fascinating to see all this slide together. Now, of course, when you raise interest rates a lot, you get dramatic impact on the building market, right? On the sector, on the building sector, anything that gets built. The first place this shows up is mortgage applications. And we've seen them collapse, basically. And the reason why is because affordability has really been dramatically impacted by the interest rate hikes, but also because of the level of those homes already. Now, I'm here down in North Carolina. I did something crazy about a year ago. I bought a home down here that had appreciated 40% in 2 years. Now, that's crazy, except that the mortgage rate I got was around 3%. So it made it affordable. I could handle it. A mortgage at 6%, I would not be able to handle it. Trust me. And that's what a lot of other people are dealing with right now, that affordability. And we're seeing it now filter through finally. I think it's been 5 months in a row where home builders are very negative on what's going on in their sector. So you're starting to see it feed through to all of the surveys, to the people that want to buy homes, to the people that are going to build homes. So we'll have a lot more supply coming on the market. But at these prices, it's going to be really tough. So we're going to need a price adjustment to bring those people back into the market to get them to buy, or we're going to need to see a significantly lower interest rates. Now, with that in mind, there is good news. I know many of you source material from outside of the country at a lot of different places. And the good news is this. We're really starting to see a change in the supply chain pressure index. And this talks about shipments. It talks about cargo costs. Those are down significantly. this is a pressure index from the New York Federal Reserve, and it's falling significantly from the peak in December of 21 now to where we're at. It's down 75%. And this is helpful when it comes to not only building supplies, but really across so many different products. And really, if you think about it, refrigerators, stoves, everybody uses chips, right? Smart refrigerators certainly do. So if you're trying to get durable goods and put them in the homes or apartments or whatever, it's hard to get refrigerators when you can't get the chips because you can't get them built, right? That's the problem. Now that's easing significantly. So that's good news. Fuel, yeah, this is diesel is the red line, gasoline is the blue line. They've come off from their peak, but they're sneaking back up a little bit. As I mentioned before, though, natural gas is falling significantly. So that's great news. Hydrocarbons are so important, especially natural gas, in the creation of so many different products in energy creation. This is really going to help, but we're still pretty high. So this is something that's good news to some extent because I think we're past the peak significantly. And I want you to keep that in mind. So as we look into the future, this is the crazy part. Believe it or not, third quarter GDP is running at about 2.8%. It's actually decent growth right now. Now, the crazy thing about this is, too, everything seems to be a little bit crazy right now. But take a look at this graph. What's interesting about this graph is that literally about 3 weeks ago, GDP was running at 0.3% for the third quarter. Now it's 2.8%. That's volatility and just the economic number. So you can imagine it's kind of hard to model this stuff. But what I think is interesting is this is a model from the Atlanta Federal Reserve, and many of the people in the market, myself included, and the economy look at this number because it really does mirror and predict what GDP will be. It does a very nice job with that. So for the third quarter, actually, things are going to be pretty good. As we get that data and we head into the fourth quarter, things will change. Now, overall, the models that are predicting what the end of the year into next year, they don't look so good. For the developed market, the advanced economies, we're only looking at 1.1% plus GDP for 2023. And that's not pretty. Europe could be in a recession already because of the cost of energy. But look at those numbers for the global economy overall. But then in the emerging markets, in China, places like that, developing economies, they're half of what they were in 2021, and they're about the same for 2022. But my goodness, that's a huge change. And so I would just say this. I do expect this is where we're going, but take a big grain of salt with this because there's so much uncertainty. I'll give you an example. If the war in the Ukraine stopped suddenly for some reason, and we could get grains out, we could get fertilizer out, we could get all the things that we were not getting during the war out from both Ukraine and maybe Russia, then the world changes significantly. But if that war goes on for much longer or escalates, or God forbid, there's a nuclear development there, then we've got a bigger problem. And so that's what I want you to, that's the X factor I'm talking about. So keep that in mind. And one other thing, just for the predictions going forward, and this comes from Moody's. I love Mark Zandi. He does a great job over there. But they're predicting that cost for container ships, the supply is going to greatly exceed demand. And so that'll put downward pressure on cargo prices. And again, I would just go back to that real simple way of describing the U.S. economy, 70% spending on services and 30% on goods. This summer, we saw that percent of services, return back to that 70% level, and the goods dropped down. And that's what we want. That shows up in places like Target and Walmart's inventory numbers, and the way that they're telling investors right now where they see some problems. And prices actually for goods in the CPI data that we just got out are actually flat to negative. So that's a great way of showing that we're adjusting back to where we were prior to the outbreak of the virus. And that's good news overall for inflation. But as you make that adjustment, you have a drop in goods, drop in their prices, and then you have a demand increase for services and for labor. And that's where you get more inflation there. So keep that in mind. All right, here's the big payoff. Where are things going for the Federal Reserve? That's really what the game is. Now, take a look at this. this is core PCE, right? The top level. It's running at about 4.9% right now. Fed funds are at 3.25%. The Fed told us this is the number that they focus on, right? So that's what we want to focus on. It's no wonder that the Fed said that they were targeting Fed funds at 4.5-ish, maybe 4.75 in their last communique, because that's where PCE is, core PCE. So that's what we need to focus on. This is actually the spending that consumers do versus where in the CPI that's a little bit different. So this is something where I think is really important if you just want to keep an eye on this more than CPI, more than all the other stuff, because this is what the Fed is telling us. So that's what we want to take a look at. Now, with that in mind, we're still 165 basis points away from where Fed funds meets core PCE. And if you want to get to what we call neutrality for interest rates, where you're neither stimulating nor draining away funds, right? That's neutral. If inflation stays robust, right? If core PCE stays at these levels, then I think the Fed is going to go above 4.5. They'll go to probably 5%. But I do believe core PCE is about to turn over, and I think it'll stay around 4.5 as we get into the end of this year. By next summer, I see this thing dropping in half to about 3 to 2.5%, and then back down to about 2.25 by the end of 2023. That's my own estimation of where I see things going. So that means we're getting close to peak interest rates for where the Fed's taking things. But there's a lot of uncertainty around that. As I said, if there's a nuclear war somehow in Ukraine, then we've got bigger problems, right? And we're going to see it cascade through all of the economy and the markets. So keep that in mind. And this assumes, by the way, really no recession. So that's what I'm looking at when it comes to this. All right. So this is the big question. Will we get a soft landing? I don't know right now. It's predicated upon where Fed funds go. If we don't see Fed funds much above 4%, if we see inflation really start to ease off, then we'll think we're going to get a soft landing. If the Fed takes interest rates to 5.5%, that's short-term interest rate, then we're definitely going to get a recession. I would put odds around 85% on that. So the takeaways are these. Right now, I've got about a 65% chance of a recession in the first half of next year because inflation is not going to come off as fast as we want. And I think the Fed's going to continue to raise interest rates because of that. But supply chain is definitely improving. Labor supply is going to remain challenging. We'll likely need to see the unemployment rate go up by at least a full percentage point to see that improve. But inflation is slowing, but I do think it's going to remain somewhat elevated through most of next year until about mid-year, and then it'll start to decline. With that in mind, let's talk about government's policies and elections, because guess what? Now more than ever, they matter. That's what we learned from COVID, that's for sure. Whether it's here in the United States or whether it's in China, these things matter. Now, it's time for another poll. Woo-hoo! All right, take it away, polling question.
All right, the second polling question, what policy will have the biggest impact on your business? A, interest rate, monetary policy, B, energy policy, C, trade and foreign policy, or D, environmental climate policy? And while you're responding quickly here, I do want to remind you that you need to respond to at least 3 of the 4 polling questions to get your CPE credit. We'll leave it up another 10 seconds. All right, last chance to submit. All right, here are the results.
All right, yep. I sold that pretty well, didn't I, in the last? All right, that's good news. I think everybody's spot on with that. All right, let me get into the next section. Look, there is a lot going on in environment and energy right now, for sure. And it's driving a lot of inflation, and it's driving Federal Reserve policy. But I will tell you, the biggest shift that we've seen in our lifetime when it comes to policy has been from the Trump administration to the Biden administration. And as a consultant, one of the things that we do is take a look at elections pretty closely, and we look at their policies of all of the candidates and how they align or don't align with the other side. And what we saw in 2020 when I was looking at all the candidates, and really we did the research in 2019, well before the election, was that all the Democrat candidates had a lot on climate. And so I told all my energy clients, like, look, I don't know what you think is going to happen, but if a Democrat wins or if Biden wins, you're going to see the largest shift in our lifetime. And most of them just kind of poo-pooed that. They're like, how's Trump going to lose? He's a sitting president. What could possibly happen? Well, COVID, for one. And that really changed the election quite a bit. So now we have President Biden, his whole administration, everyone in it has some kind of background in climate. Just take a look at his chief economic advisor, Brian Deegan. He came from, where did he come from? He came from BlackRock. What did he do for BlackRock? He did ESG investing. So just as a microcosm of looking in the personnel as policy when it comes to government, this is where they're at. And so President Biden followed through on a lot of the things that he said he was going to do when it came to the environment and energy. All of these things below is what he's agreed to do. So from that standpoint, he's followed through. But this is really important. This is suffused throughout all levels of the U.S. government. Now, the last bill that was just passed has an enormous amount of subsidies directed towards changing the output of greenhouse gas emissions. Again, on these slides, there's a URL code down at the bottom. We wrote recently a 9-page paper describing all of these subsidies. I highly recommend you read it because it likely covers so much of your industry, but like there's so much stuff that goes on in building and energy and all of that. I think it behooves you to take a look at this. It's just astonishing how much money's in there. Now, I would say this too, there's a lot of money for research and there's an enormous amount of money for loans. The Department of Energy has a loan department that's got $250 billion of firepower. And they're going to really jack up not only companies that have interesting products to bring to the table to deal with greenhouse gas, but just all sorts of different technologies that are out there, anything that they feel that they can scale up to the $1 trillion level to really make an impact on greenhouse gas emissions. That's what they're going to fund. So keep that in mind. I mean, this is really seminal. So there's a lot going into research, and there's a lot more that are going into companies that have done the research, and that will be impacting our economy in a way of shifting away from fossil fuels. So I'm not a huge fan of subsidies. I think that subsidies are very expensive overall, but there's a lot of things that are really good that are going to come out of these. So I just highly recommend everybody take a dive into those. The other thing, too, when it comes to policy, trade policy is very important. I just put up there the Chips and Science Act under China. That's super important. If you think about how important Taiwan is to the global economy because of the chips that they produce, they are super important. When you're looking at X factors, right, exogenous factors, if China decided to put a blockade around Taiwan, you would see stocks sink rapidly. You would see a lot of the economy slow down because we wouldn't be able to get the chips that we want. So that CHIPS Act is a way for the United States to build the infrastructure, to build the ecosystem of chips here in the United States, and certainly away from China and certainly away from Taiwan Semiconductor in Taiwan. We're encouraging companies to build here, and that is happening. There's about 4 different fab plants that are being built as we speak, 2 in Austin, 1 in Phoenix, and 1 in Ohio. So that's good news. A lot of stuff going on there. But this last executive order that President Biden put out is causing all sorts of disruption in the chips market. Anybody who's producing something in China, this is really a problem. And I think China and the United States are going to be butting heads for some time. So we'll see how this plays out. The opposite is Europe, right? Europe needs our help. We need to supply them with as much LNG as we possibly can. But there's a lot of good things, sadly, that are coming out of the Ukraine war, one of which is Germany's decision to step up and spend $100 billion on defense. Another one is Sweden and Switzerland getting off their neutrality bottoms and deciding that this is, yes, an existential threat of Russia taking over the Ukraine, because they're right next to the, they get done with the Ukraine, they're not going to stop there. So this is what's going on. There's some positive things happening there. Now let's switch into the elections because they're right around the corner, November 8th. These are my top 5 for where I see this election falling down to. I would have said prior to the Supreme Court ruling on abortion, this would have been a layup for the Republicans to take back both this House and the Senate. The reason why I say that is because President Biden's approval ratings are in the tank. They're terrible right now. There's a negative 14-point difference between approved and disapproved. So that, typical midterm elections are referendums on whoever's in power. So keep that in mind. Now, I don't think it's great to make predictions about the outcomes. I'm neither here nor there whether, is Republicans going to win, Democrats are going to win. Republicans are terrible, Democrats are terrible. No, that's not me. What we're trying to figure out is where does growth come from and what are their policies. And this is kind of an outline that I put together. By the way, I did a little bit more detail of this on the website. We just posted it on Sunday, so you can go there again and get the research there. But just take a look at this and scroll down through some of this. I would add to the Unified Republican that just recently we heard from Kevin McCarthy, the supposed next leader of the House, should the Republicans win, that they might think of dialing back military spending for the Ukraine. One thing they want to ramp up spending on is on energy production in the United States. So just as an example of some things that are happening as we get closer and closer to this election. So these are the things that I think are interesting. Now, what's also interesting about this is its impact on the 2024 elections. Obviously, these are the 2 people that ran last time, and so far, from what I can tell, that they'll run again. But I would caution you on that, depending on what the outcome of this election is. If the House and Senate both go to the Republicans in a significant way, I find it extraordinarily difficult that President Biden would run again. He's 82 this month, and I think it'll be, or 80, I should say, he'll be 82 in 2024. I just find it really difficult that he would want to try to run again. Now, on the other side of this, former President Trump, he obviously was very involved in the primaries of the midterms. A lot of his candidates won. If they don't win in the general election, then I think a lot of pressure will be on him to not run in 2024. One person I think is worth keeping an eye on, obviously, is Florida Governor DeSantis. They just had a hurricane go through there. He needs to be able to bring those areas back up on their feet, or he will not be able to run very effectively as a candidate in 2024. So keep that in mind. The midterm elections impact much more than just what's going to happen over the next 2 years. All right, with that in mind, let's jump into the trends and to the case study. So the trends, wait, time out. Before we do that, let's do another poll.
Yeah, so our third polling question is, where are the largest opportunities for growth? Population shift, space, renewable materials, or water availability? Again, we'll try and move through this one pretty quickly to get back to our content. Another 5 seconds. All right, here are the results.
All right, excellent. Here's a little secret. All of these are going to impact you. Let me get to this. All right, these are the trends that have been supercharged both under COVID and the Ukraine war. I think everybody's familiar with them. I'm going to go really quickly through this section. But what's interesting is population trends. Now, there's 2 graphics here that I think are impacting your industry and will continue to impact your industry going forward. One is work from home or work from anywhere. On the right side of this, you see that there are still 30% of days worked are from home. And that is interesting. This impacts the core business centers of cities like New York, like Chicago, like LA, like San Francisco. People are still working from home. That means they have to stay close by, but they don't have to live in the city. And that means also that you're going to get more things like hoteling when it comes to coming into the office. Now, I know a lot of financial firms, I know a lot of firms that are in the middle of the city want their workers to come back. But guess what? We've learned that we can do this very simply by working at home, whether it's Zoom, Teams, you name it. So that the workers are pushing back pretty hard against the employers to keep this structure in mind, or in place, I should say. The other side of this, this is where things get really interesting. So what this is, like everybody's heard of the census, right? 2010 to 2020, Census Bureau put out this information. Well, they also put out a little survey that they did from the summer of 2020 to the summer of 2021. And that graphic shows it. So what we see there is movement of people, right, from the North and the Midwest, the Northeast and the Midwest, down to the South and to the Mountain West. What's fascinating is you see that California lost population for the first time. Obviously, this has massive implications when it comes to building and construction and all of that. It's so much easier to make money where people are moving to. I mean, bottom line, whether you're in services, whether you're a dentist, whether you're cutting lawns, it doesn't matter. If there's more people moving to that area, there's more demand for those products and services and more demand for housing. And that's what you see here. It's pretty extraordinary that Florida, even with all of the risks with hurricanes and things like that, they still got a 1.5% growth or 1.1% growth in population just in that last year. So overall, over the last 11 years, they've had a 16+% increase in population. Ladies and gentlemen, that's fantastic. If you want to grow, that's how you do it. And that's why, by the way, Florida Governor DeSantis is a presidential candidate. So keep that in mind. This, basically, everybody knows it was adapt or die for small to medium-sized firms. The one thing I do want to point out, obviously, it's omni-customer, omni-channel for everyone, including everyone in the room today. You have to meet your client where they want to be met, and you better have an app to be able to do that because that's what they want. But I also think the bottom line is that you better be collecting as much data as you possibly can for your algorithm so you can learn a lot more about that customer's behavior. So keep that in mind as well. Lastly, obviously, climate change has been very, very big. It changed government policies. There's all sorts of things going on. We talked about the IRA bill, but the SEC climate disclosure bill, that's where they're asking companies to disclose if their earnings could be materially impacted by climate. And it's a law, it's a regulation that they're pushing through. That doesn't just impact public companies, it impacts public companies and all of their suppliers as well. So secondary, tertiary. So keep that in mind as you're looking at this. It's really quite complex and it puts a lot of strain on everybody to comply with it. All right, let's talk about some challenges for your industry and overall for the economy too, right? First of all, energy. This matters, right? We don't want to end up like Germany. That is basically the poster child for how not to do it. They became dependent on one energy source by an autocratic ruler. The good news for the United States is we are essentially energy independent. I mean, we have so many hydrocarbons here in the United States. It's fantastic. Whether it's natural gas or oil, unbelievable amount. And I would just say the graphic on the right comes from McKinsey, basically just saying we need a lot more energy because of, because basically of those products I told you about, cement, steel, plastics, and fertilizer. And we have to figure out where we're going to be as far as creating the base load that we need. So when we have terrible things happening, that we can supply enough energy. So it's that transition where if we go too quickly like Germany did and shut down their coal plants and their nuclear power plants, that you really run the risk of bad things happening quickly. The other thing, obviously, is clearly making our grid resilient, whether it's the hurricane in Florida or whether it's the strain that was put on it by the extreme heat that occurred in Texas. This is where I think the money from the IRA and the bill and the bipartisan infrastructure plan are really going to help. But this is something that's really important. By the way, we also need Joe Manchin's permitting bill to get electricity across state lines. Otherwise, it's going to get bogged down by state regulators or even worse, local regulators. Not to insult anybody, but that's how you stop things when you have NIMBY going on all over the place. Now, this is what's interesting, too. Now, we think about hurricanes and floods and stuff like that, but water availability is just as important. And for the reason that I point out there is that just a fab plant for a chip manufacturer, you need 2 to 4 million gallons per day. And it's not just chips, obviously, medical device. Just go down the list in almost every sector. You need water. So if we have droughts occurring in different places of the world, then we're going to have problems with being able to source products from those places. So keep that in mind when you're looking at building materials, you're looking at whatever products you're trying to get into this country. Are they in the middle of a drought? Then you're going to have a problem. All right, growth opportunities. Here we go. As I said, it's so much easier to make money when there's people moving to where you are. And the data really points this out. If you look at these two graphics, you saw that the South grew much faster than almost anywhere else because the South really didn't shut down during COVID. So not only were people moving there, but businesses weren't shut down like they were in the North and the Midwest, colder areas to be sure, and they had much bigger problems when it came to COVID. But this is also indicative, these slides show that it's indicative that business establishments recovered so much more rapidly in those areas. So population shifts really matter significantly. With this in mind, here's my crystal ball. Ladies and gentlemen, it's venture capital. And it's venture capital money. These are people who don't look out the next 1 or 2 years. They're looking at 5 and 10 years down the road. Why do they do that? Because they know when a startup is coming along for money, they're not going to grow to the scale at which they need to grow unless they have not only venture capital money, but likely PE money and other follow-ons to grow and expand. And most venture capitalists don't know which companies they're going to do that, but they know that they have a pretty good idea it's going to take that long. What you see here is building materials, and I just point out Carbix. Carbix is a really interesting little company. It takes atmospheric carbon dioxide and creates building material out of them. So what I would suggest to you is look at these companies, dive into them, see what they're up to, go to their websites, see what they're doing, see if A, you can either do business with them, B, maybe use their own ideas to help grow your own business. Try to figure out a way to take this information and learn from what these companies are doing. Remember, startups, they're very niche, right? They go into this real little space because that's all they want to do. They want to start small and then iterate. And guess what? They don't stay in their niche. They expand out, and they may be coming for your clients if you're not careful or aware of what they're doing. Supply chain. This is one of the bigger stories I see out there. It's U.S. nearshoring, EU offshoring, and it has to do with hydrocarbons, and it really has to do with natural gas more than anything. I think a lot of chemical companies will move out of Europe into the United States. You just have to move to where you can get cheap hydrocarbons. And the United States is a great place to go. So keep that in mind for building, for factories, for whatever you name it. This is something that's going to be interesting. It's time for our last poll before we get to the rest of these growth opportunities. Take it away.
All right, the last question is, how important are building data analytics and AI to you? A, very, B, somewhat, or C, not at all? And for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And then we're also sending them via email tomorrow, along with a recording of this webcast.
And we will do some Q&A at the end, but we probably won't get to everybody's questions, but we'll try to get to as many as we can.
All right, another 5 seconds here. All right, here are the results.
Yeah, so over 90%, somewhat and very. Yeah, that makes perfect sense. We'll talk about that. Yeah, massive AI adoption. We need data. We need data at all levels. Interoperable or intelligent design needs interoperable data across all platforms. You got to draw in as much data as you possibly can. Now, there's some really cool things that are going on with data accumulation, obviously having to do with drones and the construction of projects, right? It's analogous to when a farmer has a robot go through his field and snap 1 million pictures to see what's going on with the plants that are growing and whether they need to be weeded or have insecticide. It's the same thing for building, right? So I'm not saying that along the lines of we don't need estimators or accountants. No, we need to add to that to their skill sets. As we're watching a project go up, you can take pictures and look at it day to day and feed this into your data files to see how you're doing at what stage, what should be built by now, what levels of the, how far along are you as what you've estimated this project taking. This is really going to be important. The better you get at integrating the data that you're seeing from your project into an algorithm that can help you, or just even machine learning. Really, it's machine learning. As you're teaching something, try to find that data as much as you can and, plug it in. I mean, there's groups that are putting chips into cement. I mean, just as they pour it, there's really interesting things going on in that space. I just think that the better you get at collecting the data, the better you can put together a total picture of what that project looks like so that you can get better at estimating the costs. And it will also give you a glimpse into the risk management that you need to do for these projects as well. So all of this feeds together. This is super important, and it's only going to get better with time and with better data. AEVs in cars, I mean, I think everybody's seen this a lot, but I just have to hammer it home because there's a lot of growth opportunities with this. I don't know if this means building new stations to charge batteries, or if it's building out new areas for, like, let's say Hertz, that they need to have a whole section be built out for the 167,000 new EVs that they just bought from GM. There's a lot of opportunity in this space. There's just a ton going on. And to that point, you can see where all these car manufacturing facilities are ramping up production across the world, but also specifically in the United States. Again, going back to the information I talked about, the IRA bill, plus the BIF, the bipartisan infrastructure fund, both of those have subsidies in there and monies to incent companies to build battery factories here in the United States. So there's a lot going on here. Really, to underscore this, we just need energy from every source possible. Virginia just came out and said that they want to build the very first modular nuclear power plant in Virginia. The TVA has, I think, 2 modular projects going right now. There's more that's going to be coming when it comes to nuclear. As people get more confident about it, there's more building that's going to go on with that. And then, I know this is going to sound crazy, space, like what the heck, but this is growing rapidly. I don't know if anybody saw what happened with DART, right? That's the double asteroid, I forget what the RT stands for, but this is where they crashed a satellite, not a satellite, but a ship into a small asteroid to try to change its arc of its direction, and they did it. It was successful, which is fantastic. Now, that's on a very small scale. Here's the thing, right? Where this is really going to explode and growth in space is going pretty aggressively. If NASA detects an asteroid that is an existential threat to the United States or the world, right, you're going to see trillions of dollars dedicated in a really short period of time to build out that infrastructure. Now, that may sound crazy, right? Okay. And I would say this, okay, yeah, maybe that's a bit of a lottery ticket, but here's what I do know. Venture capital is flowing into this. There's been a slowdown in venture capital in 2022 and PE, but take a look at this. Just from the end of April into May, just in those 2 weeks, there were 15 fundings for space. So just to give you an example, there's a lot going on here. Really smart people are dedicating large amounts to this sector because they believe it's a huge growth area. All right, that was a lot of information in a short period of time. Again, if you want to do a deeper dive, we've got stuff on EVs, we've got stuff on space, we've got stuff on the elections, all on the website. And I think that gives us just enough time for some questions.
Okay, actually, we have 1 minute left, so I don't know that we have time for questions, unfortunately. But we will take a look at the questions submitted and follow up where we can with the individuals that submitted their questions. But thank you, Andrew, for a great presentation today. We really appreciate it. And to our audience, we hope you enjoyed today's presentation. The final session in our Building Opportunity Conference is next Thursday, October 27th where we will be covering how to attract and retain talent in the built world. So hopefully you can join us for that one as well. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks should you have difficulty downloading it now. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next week. Take care.